So one thing that a lot of investor education people don't have out there is context around what they're doing. Right. Um, a lot of people kind of, when they buy their investor products, their support resistance, their trend lines, they are imagining that they're going to turn a very small amount of money into a very large sum of money. That's sort of when you get into the industry. So that's a get rich quick kind of mentality. And, if you go on some of these Forex sites, maybe some stock people, they kind of sell you on this idea that you're gonna make just insane returns, and a lot of people get discouraged there. But their investor, the guy who sold them the product, hey, he made some money, so good for him. Now, the other type of trader is the passive person, and that's a person that's probably just in S&P, maybe has some treasury bonds, and that doesn't really work too well either because it doesn't really solve your situation. Okay, if you're 50 years old and you're looking to retire, you need to get returns. You don't have enough for retirement. Well, you need to get returns, and 7.5% CAGR is not going to cut it. And number three is kind of what's doable. What is doable in the market? Okay, just from what we see, how money works. You can't get all the money. Okay, you compound it 300% yearly. When you'll be a trillionaire pretty soon. So there has to be some sort of place where we can make enough, not too much, that it's not even believable. And that's where this concept of CAGR comes in. So one way we can see what is out there is, so we come here to Altegris. This is CTA funds. So right here you have one that's 40%, right? But when did it start? 2010, so it's got 6 years. I don't want to use that. I want to use something a little more with at least 10 years as a sort of benchmark. So here we got Omni Trading LLC, 21%, right? AROR, annualized return, whatever, similar to CAGR. So you have 21% CAGR. Then let's see, Bridge 18, EMC 18. Now this is 1985. 1985. These are, this is 18. This is doable, right? 1988, 17, 18. That's sort of doable. When you get into these kind of returns up here, I don't know if that's going to be possible, right? And this is just straight up directional investing. Here you have one, 2004 had a 21 annualized return. Here they do a variety of stuff, and then here 1990, 10%. So that's what's doable. And if you read efficient markets theory and everything, that's what it comes out to. So beat that. Look at George Soros. And we really want to use very long-term kind of returns, right? So here, supposedly, this website says 21% for Warren, 26% for George Soros. So, out of everyone that's ever traded in the world, that's kind of the most credible thing we can look at, right? Something that's somewhat audited. And that's sort of the point. that I'm trying to make here. You know, in 11 years, you could turn 100 into 1 million, right? Now, if you're at the S&P level of returns, in 11 years you're at 220. This doesn't really change your life, right? It's sort of like doesn't can't really change your life. So why would I bother with that? And that's sort of the point that I want to make here, that making more than that is probably not doable, but this is doable.